Hey, this is Keith Akata here with the Mortgage Reel at Fairway. Super excited about what led up to today and how that's impacted the mortgage market and what that still has for the forecast and how this is going to pressure rates lower. So if you haven't watched the presentation by David Stevens that we just had him for Fairway, please check the link below. You'll see in his forecast. Also, I've included his slide deck that everything you're about to watch with Barry Habib comes to fruition. And it's very exciting heading into the end of the year with so much uncertainty because of the recession, what's happening with the elections, and where that's leading us. But there is light at the end of the tunnel. So just some background, Barry Habib is the founder of MBS Highway, him and his brother Dan. I've been following now for just over close to 2 decades. And it really gives insight of what's going to happen with rates moving forward. So without further ado, here we go.
But we kind of knew that a good day was coming. We've been waiting for November 10th. And yeah, you could say it's almost like a Christmas gift here to see this wonderful green on the chart, 136 basis points to the plus side. And it's all thanks to what we thought was going to happen with CPI. As you know, we've talked about this many times with you. And gosh, I've given countless webinars and talks and live events on waiting for this day because we thought that we'd finally start to see the impact of all these Fed hikes, the supply chain easing, and inflation numbers starting to come down. And then the big one was the comparisons. Now, let's review this and let's break it down because we got a CPI number today that came in just wonderfully for the bond market. Because remember, inflation is that's the arch enemy of interest rates, mortgage bonds, because it erodes the buying power of a fixed payment over time. So inflation is going to drive mortgage rates. So let's take a look here. We're going to break this down on a chart for you. So yeah, CPI. October 22, we got that today. This is the drop we told you was coming. Let's break down the numbers first. So the headline number was up 0.4%, and the year over year did indeed drop from 8.2 to 7.7. But the all-important core rate, that's the one that the Fed's most concerned with because it takes away food and energy, which the Fed does not have influence over. That was up only 0.3%, and that caused the year over year number to drop from 6.6 to 6.3. Now, there were really drops just about everywhere. Just about everywhere, this report showed declines, except for shelter. Now, that's a really good thing because shelter is extraordinarily lagging. We've talked with you about this in the past. The way that it works is shelter really lags. But when we break down shelter, which we do, and nobody's done this, by the way. If you look, no one's talking about this number. And after we show you this stuff, it'll get out there and people will copy it and whatnot like they always do. But here's what happened. Shelter was up 0.8% for the month. Okay, that's pretty stiff, right? And this was the big driver because in core CPI, it's 39.3%. So even with shelter being up 0.8% at almost 40% of the weighting, we still were only up 0.3. So everything else was really down, right? But hold on a second. Rents were up 0.7. And then the big one here, owner's equivalent rent, which is like 3-to-1 compared to rent, it was up 0.6. So how in the world is this up 0.8? How? Well, here's why. It's because of something called lodging away from home. And it was crazy. It was up 4.9% for October. Had it not been for this, we would have gotten an even lower CPI print by another 10th. This would have been up 0.2%, and this would be 6.2 instead of 6.6. And with a 0.2% number, which it should have been, we would have we're having a celebration, but it would be even better than what we've got right now. But I want to show you, we call it crazy, right? Here's why we call it crazy. And again, no one does this, team. So please, when you talk about this stuff, you're going to be on the cutting edge because nobody's talking about this. Look at this chart for lodging away from home. I mean, heck, if a cardiologist saw this, they'd be like, let's get you to the hospital. This is crazy. Look at how wildly this number swings. And here's where we are for October of 2022. If it were down here, which we were just a few months ago, you would have had like flat CPI month over month, or maybe up only 0.1. But if it were flat here, as I mentioned to you, that CPI number would have been much better. So this is the key for us here, is that this was a crazy print. So it's got to be very, very encouraging that even with this craziness and this lodging, which could have wild swings, as you could see, we still came in with a favorable number. And that's what we are been hoping for. Now, when we take a look, I'm going to continue to show you this because let's take a look at a broader view now. So when we take a look at what to expect going forward, here's why we were so happy about getting to November 10th. And when we told you that our whole world's going to change and rates are going to be better next year and coming down, here's why. We've shown you this so many times, and boy, has this come to fruition. Again, nobody does this stuff. We're the only ones who talk about this. Remember in the spring where we told you it's going to be a brutal summer? It's because the 2021 inflation numbers were so low and the 2022 numbers that replaced it were higher. But then we said when we get to November 10th, we get October of 2022 to replace October 2021. And the numbers that we see here that will begin to be replaced are elevated numbers. And with all of the Fed hikes, this is what the Fed hikes do, is Fed hikes slow things down, cool things off, cool inflation. So Fed hikes help mortgage rates. It helps kill inflation. And when we see this eventually corral inflation, like we're starting to see here in October, and remember, it would be lower if it wasn't for that stupid lodging away from home craziness. It would even be a lower number here. Well, it replaces 0.6, and that's why we went from 6.6 to 6.3, and that's why you have this celebration in the bond market. But hey, look at what's ahead. Elevated numbers. We should continue to get lower numbers. In January, the shelter costs will start to come down. That's where we get over that peak, and you'll start to see an acceleration. So we should start to see some really good numbers here, team. It is not out of the question in the first half of the year to see rates in that 5% arena, maybe a little bit above, maybe a little bit below it. But good times are ahead, folks. So I want you to stay optimistic out there. Now, we did get some other news, and Jake.
Boy, can you imagine? So what are they saying? You saw that we're going to close out the year. Interest rates should be pressuring lower. In that first quarter, you saw in that chart, January, February, March. As we see the year over year, that's going to help pressure rates lower because the inflation is not going to reflect as high. And one of the key things that I do with my clients every single time I work with them is to give them an idea of what to expect. You know, what does the crystal ball hold? And so as we look at this chart, this really starts to give you some insight. So just a really quick crash course here of what you're seeing. When you see green, I'm sorry, this is taking a second but this is a good thing. This is 200 basis points. Like that's a phenomenal move in interest rates. Look at that green candlestick. So what are you trying to show us here, Keith? Let's just take a crash course on stocks. If you bought a stock at $99, went up $1, of course you made money. When you look at, when you follow the stocks and when it gains, you see green, right? And whenever you lose money, you see red. So if it goes down $1, you see red. Well, in the bond world where I live, that's upside down. So when you see the interest rates pressuring lower, you see a green candlestick like this. When you see red, that's interest rates pressuring higher. And then you see we get these little alert to locks. So this is how I educate clients on, hey, here's where we're at. Here's what the crystal ball is predicting. And it gives you insight on when the right timing is to lock, right? But this is the big thing. If we go back and we look at a 6-month chart even, when you look at the 6-month chart, what it's going to show you is this particular pattern right here. If you look at this is when interest rates were in the 7s, right? Right in here. So this goes back, we really started right here on the 21st of September. But look at that green candlestick. Right here, that means a 6. Basically at this line here, that's like a 6% rate. So now the rate starts with a 6. So now it's no longer 7, it's 6.875, 6.75. Psychologically, let's go back. All of us can remember the business that we were doing in the summer coming out of May when interest rates really started to move, but then stabilized. There is that mid-6, let's say 6.375 to 6.5 range. And then it started to move higher. And then, of course, we know what the story wrote when we came into September. But the market was very active through the summer. So with this being said, heck, I'll take that all day long when you get a number start with a 6 because psychologically, that is huge. So when you get a chance to revisit, please do so. David Stevens in that link. Listen to what he says about his forecast going into the spring. You just heard what Barry said about interest rates. That's a double whammy of just to reassure of where rates are going and how it's going to impact us. I think it's going to be a great spring market, just me personally and my predictions, and hopefully that comes to fruition. But the last piece I want to close this with is when you listen to David Stevens, he talks about the next generation of buyers, which is incredibly larger and more affluent income than the baby boomers ever were. Sorry if you're listening to this in a baby boomer or just tipping into that world, but it was a whole different time and there was a different way of making money, the different type of career paths. With the baby boomer generation coming into that, we have to also, the millennial generation coming into, we have to pay attention how to get in front of them. And a lot of it's on social media. So just a hint there, listen to David Stevens, what he says. How are you going to take advantage of the next 2 to 5 year run with interest rates going lower? And they're really saying this is the best opportunity to buy real estate. You see it all over social media now, and it's even coming to print because it just hit the Wall Street Journal. Thank you very much for listening. Let me know what you thought of this, but hopefully this inspires and motivates you to finish this year strong and absolutely kick off 23 really, really strong. Take care. Bye-bye.